It's Tuesday afternoon, January 20th, 2026. I'm sitting here, staring at something that has never happened in the 112-year history of the Federal Reserve. Tomorrow morning at 10 a.m. Eastern, the Supreme Court of the United States will hear oral arguments in a case that could fundamentally break the global monetary system as we know it. And I'm not being dramatic, I'm being precise. While you were focused on inauguration coverage today, while the financial networks were running their usual Monday programming, gold quietly printed a new all-time high of $56.60. Silver touched $95.78. These aren't round numbers. These aren't speculative targets from some permable newsletter. These are the actual prices recorded this afternoon as institutional money floods into the only assets that can't be manipulated by a president with a phone and an executive order. I'm a private commodities analyst. I've been tracking precious metals markets for over 12 years. I built this channel using an AI avatar for one reason and one reason only: speed. Because when you're watching a constitutional crisis unfold in real time, you can't afford to wait for some network producer to approve your script. The information I'm about to share with you is sourced from 153 primary and secondary documents I've been analyzing since January 13th. Court filings, amicus briefs, Fed statements, institutional research notes, and a leaked timeline that connects dots the mainstream media refuses to acknowledge. Here's what they're not telling you. Tomorrow's case is called Trump v. Cook. On the surface, it's about whether the president can fire a Federal Reserve governor named Lisa Cook for allegedly lying on a mortgage application. The financial media is treating it like a procedural dispute, a legal technicality, something for lawyers to argue about while the rest of us watch the ticker. But that framing is a lie. What's actually at stake tomorrow is whether any president, this one or any future one, can seize control of the most powerful financial institution on earth, simply by accusing a Fed official of misconduct. If the Supreme Court rules in Trump's favor, the FOR cause protection that has shielded the Fed from political interference since 1935 becomes meaningless. It becomes magic words. The president says, "I find cause and you're out. No evidence required. No judicial review. No due process." And here's the part that should make your blood run cold. This isn't happening in isolation. On January 10th, just 11 days ago, the Department of Justice served the Federal Reserve with grand jury subpoenas targeting Jerome Powell himself. The chairman of the Federal Reserve is now under criminal investigation for his congressional testimony about a building renovation. Powell went on video 2 days later and said something no Fed chair has ever said publicly. He called it a pretext. He said the criminal investigation is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public rather than following the preferences of the president. Let me say that again. The sitting chairman of the Federal Reserve just accused the Department of Justice of launching a criminal investigation to pressure him into cutting interest rates. This is not normal. This is not politics as usual. This is the architecture of central bank independence being dismantled in real time while the screens show you green tickers and the talking heads discuss quarterly earnings. Here's my primary claim, and I'm going to spend the next hour proving it to you with data, legal analysis, and the actual math the institutions are running right now. The Trump v. Cook case represents the most significant threat to Federal Reserve independence in the institution's history. If the court rules for Trump, gold is going to $5,000. Not as a speculative moonshot, as a mathematical inevitability, because once the market prices in political control of monetary policy, the inflation hedging trade becomes the only trade. And if you think 47.56 is expensive, you haven't seen what happens when central bank credibility collapses. Let me give you the snapshot from this afternoon because the numbers tell a story the headlines are hiding. Gold spot price, $4,756.60. That's a new all-time high. Year-to-date gain of 6% in just 13 trading days. One-year gain of 72%. Silver hit $95.78. Also a record. One-year gain of 180%. The metal has tripled from where it started 2025. Now look at what the big banks are saying. Goldman Sachs has a year-end target of 4,900 on gold. JPMorgan is calling for 50.55 as a Q4 average with potential peaks to 5,300. They're calling it their highest conviction long trade. UBS has 5,000 for Q3 and 5,400 in a stress scenario. HSBC sees 5,000 in the first half of this year. And here's the one that matters most. Yardeni Research has modeled an extreme scenario of $6,000 per ounce if Fed independence is compromised. These aren't permabulls. These aren't gold newsletter writers trying to sell you something. These are the largest financial institutions on the planet telling their clients to position for $5,000 gold. And they're doing it because they've run the same analysis I'm about to show you. Let me teach you the mechanism that makes this case so dangerous. Because if you don't understand why Fed independence matters, you won't understand why gold is about to explode. Think of the Federal Reserve like the referee in a football game. The players are politicians. Some want the economy to run hot before elections. Some want it to cool down to fight inflation. They all have incentives to manipulate the game. The referee's job is to call the game fairly regardless of which team is ahead or who's screaming from the sidelines. Now imagine the rule book says the referee can only be fired for cause, incompetence, corruption, gross misconduct. That protection exists so the referee can make unpopular calls without worrying about getting fired by whichever team controls the league office. What Trump v. Cook is asking the Supreme Court to decide is whether the president can fire the referee simply by saying, "I find cause," without providing any evidence that holds up to scrutiny. If the answer is yes, then the for cause protection becomes meaningless. Any president can remove any Fed official at any time for any reason, as long as they're willing to make up an accusation. And here's why that matters for gold. The entire credibility of the US dollar rests on the assumption that the Federal Reserve will do whatever it takes to maintain price stability. That's not just rhetoric, it's the foundation of the global monetary system. Central banks around the world hold dollars because they trust the Fed to protect the currency's purchasing power. Once that trust breaks, once the market realizes monetary policy is now a political tool rather than an independent economic function, the inflation expectations that anchor the entire system come unmoored. Long-term interest rates spike because investors demand compensation for the risk that a future president will pressure the Fed to print money. The dollar weakens because foreign central banks start diversifying away from a currency that can be debased on political whim. And gold surges because it becomes the only major asset that can't be manipulated by executive order. This isn't theory. We've seen this movie before. His finding was that political pressure by half as much as Nixon for just 6 months would permanently raise the price level by 7 to 8%. Not temporarily, permanently. The damage transmits through de-anchoring inflation expectations, not just through the rate policy itself. This is the mechanism. This is why the markets are pricing gold at 41,756 right now. Because if the Supreme Court hands Trump the power to fire Fed officials at will, we're not looking at a Nixon-level pressure campaign. We're looking at institutional capture. Let me walk you through the actual case because the details matter more than the headlines suggest. On August 20th last year, Bill Pult, the director of the Federal Housing Finance Agency, posted on Truth Social, accusing Fed Governor Lisa Cook of mortgage fraud. 5 days later, Trump sent Cook a letter terminating her for cause. The letter cited deceitful and potentially criminal conduct. This was the first time in 112 years that a sitting president attempted to remove a Fed governor. The allegation is this. In June 2021, Cook refinanced a property in Ann Arbor, Michigan, and designated it as her primary residence. Then, in July 2021, she purchased a condo in Atlanta and also designated that as her primary residence. You can't have two primary residences. Therefore, the argument goes, she committed mortgage fraud. Here's what the Trump administration isn't telling you. Documents obtained by the New York Times and Reuters show that Cook's loan estimate for the Atlanta property explicitly identified it as a vacation home. Her financial disclosure forms during her Fed confirmation consistently listed it as a second home. The July 2021 primary residence notation appears to be an isolated clerical error, likely made by a loan officer, not by Cook herself. No lender has claimed deception. No lender has sought remedies. Georgetown law professor Adam Levitin reviewed the documents and said this should be case closed on the Cook mortgage issue. There's no way to maintain a prosecution in light of the disclosure in Cook's loan application. So why is this case before the Supreme Court if the underlying facts are this weak? Because the case isn't really about Lisa Cook. It's about whether the president needs real facts at all. It's about whether saying the magic words for cause is enough, regardless of whether those words correspond to reality. District Judge Gia Cobb saw through this immediately. She issued a preliminary injunction blocking Cook's removal in September. The D.C. Circuit Court of Appeals denied the Trump administration's emergency appeal. The Supreme Court could have let those rulings stand. Instead, they scheduled oral arguments for tomorrow. That tells you something. The conservative majority on this court has been systematically dismantling the administrative state for years. They've already ruled that the president can fire officials from other independent agencies. The only question is whether the Fed is different, whether the Fed deserves special protection. And here's the signal everyone should be watching. In May 2025, the court issued an unsigned opinion about a completely different case involving the Merit Systems Protection Board. But buried in that opinion was a 26-word sentence about the Federal Reserve. They wrote that the Federal Reserve is a uniquely structured quasi-private entity that follows in the distinct historical tradition of the first and second banks of the United States. The Fed wasn't even involved in that case. The court went out of its way to mention it. Legal scholars believe this was the majority signaling that they want to treat the Fed differently from other agencies, that they understand the consequences of political capture. But here's the tension. This court has also been aggressive about expanding presidential power. They've ruled that the president has broad authority over the executive branch. And Trump's lawyers are arguing that the Fed is part of the executive branch. The outcome depends on which impulse wins. The impulse to protect the financial system from political interference, or the impulse to consolidate presidential authority. Now, let me connect the second assault, because this isn't happening in isolation. 10 days before tomorrow's hearing, the Department of Justice served the Federal Reserve with grand jury subpoenas targeting Jerome Powell personally. The investigation relates to his congressional testimony about cost overruns on the Fed's headquarters renovation. The building went from $1.9 billion in 2023 to $2.5 billion today. Powell testified that the increases were due to materials, costs, labor costs, and toxic contamination issues. The Trump administration's Office of Management and Budget called the project ostentatious and potentially illegal. The DOJ is now investigating whether Powell lied to Congress. Powell's response was unprecedented. He released a 2-minute video statement calling the investigation a pretext. His exact words were the threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public rather than following the preferences of the president. Stop and absorb that. The chairman of the Federal Reserve just publicly accused the administration of weaponizing the Department of Justice to pressure the Fed on interest rate policy. This has never happened before. The implicit rules of institutional decorum that have governed Fed-White House relations for decades have been abandoned. And here's what makes this even more significant. Every living former Fed chair signed an amicus brief supporting Cook, Janet Yellen, Ben Bernanke, Alan Greenspan, 3 people who between them served under 6 different presidents from both parties. Their joint statement said the Fed's ability to fight inflation is directly related not only to its actual insulation from short-term political pressures, but also to the public's perception of its independence. Yellen went further in a separate interview. She said, "If you can bring unfounded charges against your adversaries, we no longer live in a society governed by the rule of law." That would spell the end of Fed independence. This is the institutional context for gold at 47.56. The people who actually ran the Fed are telling you the institution is under existential threat. Let me run the math, because the numbers are what separate analysis from speculation. Central banks have been net buyers of gold for 15 consecutive years. In 2025, they purchased 755 tons. That's 50 to 90% above the pre-2022 average. And according to the World Gold Council survey, 95% of central banks plan to increase or maintain their gold reserves in 2026. Think about what that means. The institutions that understand monetary systems better than anyone else on the planet are systematically converting their dollar reserves into gold. Poland now holds 550 tons of gold, and more than the European Central Bank. China continues buying despite gaps in official reporting. Brazil, India, Turkey, and the UAE are all accumulating. Here's a historical milestone that almost nobody is talking about. For the first time since 1996, central banks collectively hold more gold than U.S. Treasuries. This is a fundamental rebalancing of global reserve composition. And it's happening because central banks see what you're seeing. The architecture of dollar hegemony is cracking. Now let me give you the institutional price targets because these aren't my numbers. Goldman Sachs sees 4,900 by year end. JPMorgan is calling 50-55 average, and Q4 with peaks to 5,300. Bank of America has 5,000. UBS has 5,000 in Q3 and 5,400 in their stress scenario. HSBC expects 5,000 in the first half. Commerzbank sees 4,900 by year end. And Yardeni Research has modeled 6,000 in an extreme Fed independence collapse scenario. The consensus view is that $5,000 gold is not a speculative target. It's a realistic checkpoint given structural drivers. The question is timing, not direction. Let me stress test my own thesis, because I want to steelman the counter-arguments before you hear them from the skeptics. Skeptic argument number 1. The Supreme Court is going to protect the Fed. The May 2025 statement shows they understand the stakes. They'll rule for Cook, and this whole crisis will blow over. Here's my rebuttal. Even if the court rules narrowly for Cook on the specific facts, it doesn't resolve the constitutional question. A remand to lower courts keeps the uncertainty alive for another 1 to 2 years. And meanwhile, the Powell investigation continues. The pressure campaign continues. The institutional erosion continues. The market isn't just pricing the court case. It's pricing the totality of the assault on Fed independence. A narrow Cook victory does not make gold go back to $4,000. It maybe causes a $100 to $200 pullback before the structural bid resumes. Skeptic argument number 2. Gold is overbought. The RSI is extended. We're due for a major correction. Here's my rebuttal. Technical indicators are useless when you're dealing with institutional shifts. Yes, RSI is elevated. Yes, the rally looks stretched on the charts. But position sizing is not extreme according to the World Gold Council. This isn't a speculative frenzy. It's institutional reallocation. And institutions don't sell because a chart looks overbought. They sell when the fundamental thesis changes. Nothing about tomorrow's hearing changes the fundamental thesis that Fed independence is under attack. Skeptic argument number 3. The Fed will remain independent regardless of what happens in court because any president who actually seized control would face such severe market consequences that they'd back off. Here's my rebuttal. This argument assumes rational actors operating in good faith. Look at what's already happened. The president called the Fed chairman a numbskull and a stubborn mule. He's publicly demanded rates as low as 1% when the current range is 3.35 to 3.75. He's had a government agency accuse a Fed governor of fraud based on what appears to be a clerical error. He's launched a criminal investigation into the Fed chair over a building renovation. Does any of this suggest a rational actor who will be deterred by market consequences? The skeptics are betting on institutional resilience. The gold market is betting on institutional breakdown. And 755 tons of central bank buying suggests the gold market is winning that bet. Now, let me give you the scenario analysis because the court has 5 possible paths and each one has different implications for your portfolio. Scenario 1, full victory for Trump, 15% probability. The court rules that the president has unreviewable discretion to determine cause. Cook's removal stands. The for cause protection becomes meaningless. Market impact. Gold surges $200 to $300 immediately toward $5,000. Treasury yields spike 20 to 30 basis points as the curve steepens. Dollar weakens 2 to 3%. Silver breaks 100 and keeps running. Scenario 2, narrow victory for Trump. 25% probability. The court upholds Cook's removal on these specific facts, but preserves judicial review for future cases. Market impact. Gold rises 100 to 150, testing 4,900. Uncertainty persists. Fed credibility moderately damaged. Wait-and-see mode for actual policy changes. Scenario 3, compromise or remand, 30% probability. The court sends the case back to lower courts for further factual development on pretext. Market impact. Muted immediate reaction. Gold consolidates in the 4,600 to 4,800 range. Ongoing uncertainty sustains safe haven bid. No resolution for 1 to 2 years. Scenario 4, narrow victory for Cook, 20% probability. The court rules Trump's stated cause was pretextual or factually insufficient, but issues a narrow ruling. Market impact. Gold pulls back $50 to $100 on profit taking. Consolidates around 4,500 to 4,600. Other safe haven drivers keep it supported. Scenario 5, full victory for Cook, 10% probability. The court issues a broad decision affirming Fed independence with robust judicial review of removals. Market impact. Gold drops $100 to $200 to 4,550 to 4,650. Relief rally in risk assets. But the structural bull market remains intact because the other drivers haven't changed. Geopolitics, central bank buying, fiscal deficits, they're all still there. Here's the critical insight. In 4 of the 5 scenarios, gold either goes up or holds. The only scenario where gold meaningfully corrects is a full Cook victory, and even then, the pullback is modest because the structural case remains overwhelming. This is asymmetric risk. The downside is capped, the upside is open. Now, let me tell you what I'm watching tomorrow and over the next 2 weeks, because this is about to move fast. First, the oral arguments themselves. Listen for the questions the justices ask. If they focus on the Fed's quasi-private status, if they emphasize the unique historical tradition language from the May 2025 opinion, that's bullish for Cook. It means they're looking for a way to protect the Fed without overturning their broader removal precedents. If they focus on Article 2 executive power and presidential authority, that's bearish for Cook. It means they're prepared to apply the same aggressive removal doctrine they've used for other agencies. Second, watch the February 1st tariff deadline. Trump's 10% tariffs on 8 European nations, including the UK, kick in on February 1st. These escalate to 25% on June 1st if there's no Greenland deal. The tariffs aren't directly about gold, but they are part of the same institutional volatility that is driving safe haven flows. Every escalation reinforces the flight to hard assets. Third, the Fed Chair announcement. Trump said he'll announce Powell's replacement within weeks. The leading candidates are Kevin Warsh at 60% odds and Kevin Hassett at 16%. Christopher Waller is at 14%. The announcement of a shadow chair could influence market expectations months before Powell actually leaves. If Trump picks someone perceived as a political instrument rather than an independent economist, gold will react. Fourth, the FOMC meeting on January 29th. The Fed is expected to hold rates steady at this meeting. But the statement language matters. Any hint that the pressure campaign is affecting policy will be read as dovish. Any strong reassertion of independence will be read as hawkish. Watch the statement closely. Fifth, watch the Treasury yield curve. The 10-year is at 4.29% right now. The 10-year break-even inflation rate is at 2.29%, the highest since November. If the curve keeps steepening, if long-term yields keep rising while the Fed is under pressure to cut short-term rates, that's the market telling you it doesn't trust the Fed to control inflation. That's the canary in the coal mine. Here's my personal dashboard. I'm watching the 43.60 level on gold as the first support. That's the October 2025 high. If we pull back and hold above 43.60, the trend is intact, and any dip is a buying opportunity. Below that, I'm watching the 50-day exponential moving average at 4.255. A close below 4.255 would be a warning sign. Below the 200-day EMA at 37.30, the bull market would be invalidated. I don't expect us to get anywhere near that level unless we get a full Cook victory plus simultaneous de-escalation on every geopolitical front. The probability of that combination is less than 5%. For silver, I'm watching the $100 psychological barrier. If silver breaks and holds above 100, the momentum will accelerate. The industrial supply deficit is real. The physical premiums are screaming. The structural case for silver at 100 plus is even stronger than the case for gold at 5,000, because silver has both the monetary component and the industrial component working in the same direction. Now let me address something that might be on your mind. Why should you trust some guy with an AI avatar telling you about the most important Supreme Court case in Fed history? Fair question. You shouldn't trust me blindly. You shouldn't trust anyone blindly. But here's what I can tell you. Everything I've presented in this video is sourced from public documents. The court filings are on the Supreme Court docket. The institutional price targets are in published research notes from Goldman, JPMorgan, UBS, and the rest. The central bank purchase data comes from the World Gold Council. The legal analysis comes from law professors at Georgetown, Columbia, Harvard, and Berkeley, who have been writing about this case for months. I'm not making predictions based on my gut. I'm synthesizing information that's available to anyone willing to do the research. The difference is, I've been doing this for 12 years. I know where to look. I know how to connect the dots. And I have the time to spend 10 days analyzing 153 sources, while most people are living their lives. The AI avatar lets me get this information to you fast. That's it. The analysis is mine. The data is from primary sources. The avatar is just the delivery mechanism. And if I'm wrong, if the court rules for Cook tomorrow and gold crashes to 4,000 and the whole thesis falls apart, I'll come back on this channel and tell you I was wrong. I'll show you where my analysis broke down. That's how you build trust. Not by pretending to be infallible, but by being honest about uncertainty. Let me give you the broader context, because gold at 5,000 is not just about one court case or one criminal investigation. The United States is running a national debt of $36 trillion. That's 130% of GDP. Interest costs on that debt are approaching $1 trillion per year. That's becoming the largest line item in the federal budget. There is no credible deficit reduction plan from either party. The debt trajectory is unsustainable by any conventional measure. At the same time, the administration is pursuing tariff policies that threaten to fragment the global trading system. 10% tariffs on NATO allies. Potential 25% escalation. 200% tariffs threatened on French wine. These aren't the policies of a country that's confident in its economic position. These are the policies of a country that's trying to extract concessions through economic coercion. And simultaneously, the architecture of central bank independence that's been the foundation of dollar credibility since Paul Volcker is being systematically dismantled. The Fed chair is under criminal investigation. The Fed governor is fighting for her job in the Supreme Court. Every living former Fed chair has signed a brief warning that the institution is under existential threat. Put all of this together, and what do you get? You get a structural environment where hard assets, gold and silver specifically, become not just hedges, but necessities. You get a world where central banks are converting dollar reserves to gold at the fastest pace in decades. You get institutional investors calling gold their highest conviction long trade. This isn't about being a gold bug. This isn't about being a permabull or a doomer or whatever label the skeptics want to apply. This is about reading the data honestly and positioning accordingly. The 10-year break-even inflation rate at 2.29% tells you the market expects inflation to run above the Fed's 2% target. The steepening yield curve tells you the market is demanding more compensation for long-term uncertainty. The 755 tons of central bank gold buying tells you the institutions that understand monetary systems best are hedging their dollar exposure. When the signal is this clear from this many independent sources, you don't need to be a genius to read it. You just need to be paying attention. Tomorrow at 10 a.m. Eastern, the Supreme Court will begin hearing oral arguments in Trump v. Cook. By the time the session ends, probably around noon, we'll have a much better sense of where the 6 conservative justices are leaning. The decision itself won't come until spring, probably April through June. But the questions asked tomorrow will move markets. I'll be watching every word. And if something significant happens, if a justice signals their position or the arguments take an unexpected turn, I'll be back with an update before the markets close. Here's my 3-sentence recap. Tomorrow's Supreme Court case represents the most significant threat to Federal Reserve independence in 112 years. Gold at 47.56 is not a bubble. It's a rational response to institutional uncertainty that every major bank has endorsed with $5,000 plus price targets. The asymmetric risk profile means gold trends higher in 4 of 5 possible court outcomes, with only modest downside in the 5th. The screens are going to show you a lot of noise tomorrow. Talking heads will debate the legal technicalities. The tickers will flash green and red. But underneath all of that noise is a simple reality. The architecture of central bank independence that has been the foundation of the global monetary system since 1935 is on trial. And the verdict, whatever it is, will move markets for years to come. Stay sharp, stay positioned, and don't let the noise distract you from the signal. The opportunity is right in front of you. The math is clear. The institutions have already placed their bets. The only question is whether you'll place yours before the gavel falls.